Hi everyone, I'm Mr. Te from the Modern Reminder. Do you know that in year 1500, the annual production per capita was $550? Today, the amount is around $11,000 per capita. It means that on average, each of us is producing and consuming 20 times as much compared to our ancestor 500 years ago. How did we manage to do that? There are many answers to it: growth, inflation, technological advancement. But what is the underlying factors? The short answer: the capital market. And that is what we are going to talk about today. But first thing first, before we can talk about the capital market, we need to understand a concept called the trust in the future. You see, capital market alone is not enough to grow the economy. How do I know that? Because we can see the concept of credit, which is a form of capital, in all non-human culture, even going back to the ancient Sumer. However, in most part of the world history, the world's economy remained the same. Only until year 1500 or so, it started to grow exponentially. Why is that? It was because at that time, we started to develop this trust in the future. So what is the trust in the future? What am I talking about? You see, in pre-modern society, people generally thought that the future would not be better than the present. Put it in economic terms, it means that the total wealth of the society was believed to be limited or even dwindling. Every business opportunity has already been discovered. Every demand has already been met. Business thus looks like a zero-sum game, like a pie that will only stay the same in size. And in order for you to get more pie, you have to take it from the others. It's no wonder in most culture, making a lot of money is considered sinful. Now think about it, why would we invest our capital in the first place? Because we believe that the pie in the future would be bigger than the pie in the present. So by investing the capital, we would benefit from the growth in the size of the pie. If the pie was to remain the same, why would I invest my capital in the first place? Under such a belief system, the capital was limited. And because the capital was limited, the cost of capital was high. Cost of capital can be understood as the price you pay in order to get a capital. Because the cost of capital was high, people were having trouble financing new business. And because people were having trouble financing new businesses, the economy did not grow. And because the economy did not grow, we assumed that it never would. And because we assumed that it never would, we were reluctant to extend the capital. Now, do you see a self-fulfilling cycle here? Say you were a teenager in the pre-modern society, wanted to open a milkshake business, but you didn't have enough capital. So you proposed your business plan to the rich uncle in your family. Under such a belief system, it didn't matter whether you can make good milkshake or you have good integrity. It was unlikely for your rich uncle to invest the capital into your business. Even if it did, the interest is going to be very high, which is the cost of capital. And your new startup won't be able to survive from it. But in the modern society, the wheel turned the other way around. We generally think that the future will be better than the present. So we are generous or even eager to invest our capital. Because we are eager to invest our capital, the capital is abundant. Because the capital is abundant, the cost of capital is low. And because the cost of capital is low, it's easy for people to finance their new businesses. And because it is easy for people to finance their new businesses, the economy is always growing. And because the economy is always growing, we assume that it will always be. And because that we assume that it will always be growing, we are always generous in investing our capital. Now this is also another self-fulfilling cycle, but only the other way around. Let's see how it plays out in the modern society. Say you are a teenager in the modern society, you want to open a milkshake business, but you don't have enough capital. Similarly, you approach the rich uncle in your family. If you have good integrity, you can make good milkshake, you have good business model, it is likely that your rich uncle will invest in your business. If he invests capital in your business, in return, he wants interest and principal back. These are the two keywords here. It is called debt financing. If he sees bigger potential in your business, He invests capital in your business, and in return he wants some ownership. Ownership is a keyword here. It is called equity financing. Whether it is done through debt financing or equity financing, this is the very basis of capital market. Let's call it capital market 1.0. 3 years have passed. Your milkshake business is so successful. Now you are thinking to open few more outlets. But even your rich uncle don't have enough capital to support this kind of expansion. Lucky for you, there's a place where people deposit their savings, and the place uses the savings to fund businesses. We call it the commercial bank. So you approach the bank, and then the bank agrees to inject capital into your business in return for interest and principal. So it is debt financing. But now it is done through a middleman, which is the commercial bank. We call it capital market 2.0. Another 3 years have passed. Now you own outlets all over the nation. But you start to think, how much money you can make by selling this milkshake in the shops anyway? Why don't you turn them into packaged product and then distribute them to the supermarkets? It means that you need to have your own manufacturing line, own distribution line, aggressive advertising. In other words, a whole lot of new capital. So you approach the bank again with your new expansion plan. But suddenly you sense that there's a change in the vibe. The bank manager that you got so close to, suddenly he doesn't share your enthusiasm. You see, commercial banks, they tend to be conservative because whenever a bank loans you the money, it is exposing itself to the risk of your business while only earning the interest differential between the deposit and the loan. So the bank turns you down, but it doesn't necessarily mean that your business plan is not good. But it could mean that, first, they don't have the expertise to analyze your business, and second, the risk is just too high for them. But you know that there must be someone who knows your business well enough and has the risk tolerance to invest in your business. This is where the investment bank comes in. Unlike the commercial banks, the investment bank, they don't expose themselves to the risk of your business. In other words, they don't loan you their own money. Instead, they study your expansion plan, they repackage it, and then they sell it to their clients. Often their clients are private investment fund, public retirement fund, or even some high net worth clients. So if you want to go for debt financing, they will issue bond on behalf of you and then sell it to their clients. The money you get from selling this bond will be injected to your company, to your business, and in return you have to pay these bondholders interest and principal later. If you want to go for equity financing, they will issue shares of your company and sell it to their clients. And then the money you get from selling these shares will be injected to your company, and in return, these new shareholders, they will be sharing the profit of your business. Now the capital market is done through a middleman as well, but now the middleman is only serving as a bridge, which is the investment bank. We call it capital market 3.0. Now we have come to the last stage of the capital market. Let's say you issue a bond with a maturity period of 10 years. It's not that all the bondholders are going to hold the bond for 10 years only to get back their principal. No, before the maturity date, they could sell it to others, maybe at a premium, maybe at a discount, but whenever there's buying and selling, there's a market. We call it bond market. Same goes to equity financing, but it is usually done through a more formal process called the IPO, Initial Public Offering. After the IPO, your milkshake business is going to be a public listed company, so it can be traded on the stock exchange. Therefore, after the IPO, the shareholders of your company, including yourself, could sell the shares to anyone who owns a shares trading account. The ownership of the shares will then be transferred to those who buy them. Now, when we have a public platform for us to trade the bonds or to trade the stocks, we have come to the last stage of the capital market. We call it capital market 4.0. But bear in mind that this is not a step-by-step process. This is just a demonstration of the development of the capital market. What have we learned today? We learned that capital market and the trust in the future is what keep the economy running and growing. Trust in the future, put it differently, you can call it business confidence. Once we lost trust in the future or we lost business confidence, the economy could turn the other way around. And also, the trust is not only in the future, there's trust in the subject itself as well. What do I mean by that? Give you an example. On the national level, the credibility of a nation or its judicial system represent the trust that determines our access to the capital which is needed for national development. That is why from time to time you see capital market update, foreign direct investment update by the regulators, because they are sending very important messages. A country that is blessed with natural resources but terrible credibility or corrupted judicial system is going to have a hard time raising their capital. The same applies to the company and personal level. A company that has already earned the trust is easier to get the loan approved. A person that has already earned the trust usually gets more opportunities. Let me tell you a story. Someone actually asked me before, why did we make a big fuss out of the 1MDB issue? After all, the money stolen was about 2% of Malaysia's GDP per year. Now you know why. Because it undermines our ability to raise capital, and for that our economy has to pay a hefty price. Recently we have this serba dynamic issue. Same thing. We also learned that capital market, it all started from the intention to seek capital, to state the obvious. And there are two ways of doing it. First, debt financing, where interest and repayment of principals is involved. And second, equity financing, where the issuance of new ownership is involved. Debt financing eventually developed into the bond market, and equity financing eventually developed into the stock market. When you look at it from another perspective, whenever you are investing in bond, it means that you are lending your money in hopes to get all the interest and principal back. And whenever you are investing in stock, it means that you are buying into the ownership and sharing the profit and loss of the company. I also like to point out that whether you are depositing your money into the bank account, or you are investing in bond, in shares, in unit trust, or you are contributing to EPF and EPF is using your money to invest in this asset, one way or another, you are already in the capital market. If you are interested in one-stop financial services, be it stock, bond, unit trust, PRS, structured products, you name it, or even if you are interested in listing your business like my milkshake example, click the link to the Google form below. My team will get in touch with you. And if you like this video, do the usual. Like, share, subscribe. Until next time.